So thank you everybody for joining. I'm Mike Leibovitz. I'm an international tax partner in Mayor Brown's tax practice in Los Angeles. Joining me on our panel today are Jenny Austin, tax controversy partner in our Chicago office, Lucas Giardelli, a tax partner in our New York office, James Hill from our London office, who heads our UK tax practice, Ken Klein from DC, one of our senior international tax partners, and Warren Payne, who's a senior advisor in our Washington DC office and somebody with a long history working on the Hill. So before we get started, a couple of announcements. At some point during the presentation, we're going to read a CLE code, which you need to include. You must record this in the sign-in sheet that was emailed to you along with the presentation. We're going to be sending out the slides. Everybody after the session will get a copy of the materials, and the session is being recorded. And so that will be available as well. There is a Q&A function somewhere on the bottom of your screen. We've got a lot of material to cover in the next hour. We'll try to get to your questions. If we don't, we'll follow up with you afterwards to the extent that we can. So with that, let's go ahead and get started. And here's what we're planning on covering today. We'll start out with just a couple of minutes on the G20 agreement and how we got to this stage, and then we'll dive into sort of the details around Pillar 1 and Pillar 2. We'll focus first on Pillar 1, and we'll spend a few minutes talking about DST repeal, Digital Services Tax repeal, what that means. Then we'll dig into some of the details around Pillar 2, and then we'll pivot and start looking at some of the Green Book proposals and the U.S. legislative outlook around that. We'll touch on some of the specific provisions in the Green Book, particularly those that intersect with with Pillar 1 and Pillar 2. And then we'll finish up with a discussion on what's the roadmap? Where do we go? Does the Pillar 1 and Pillar 2 have any? How will that be implemented in the U.S. and how will that intersect with the Biden tax proposals, and what's the legislative outlook around that? So with that, let's just spend a couple of minutes on how we got here. So as we all know, the world has been trying to figure out how to tax the digital economy for decades now. Back when the BEPS initiative first started back in 2012, 2013, 15 action plans, but action 1 was digital, the attempt to tax the digital economy. And despite a lot of discussion around, how do you ring fence the digital economy to be able to tax it, there was really no movement around that. And the OECD sort of came to the realization, just because of the pervasiveness of digital in the world economy, that essentially everything was digital. And so rather than try to tax digital on its own, let's work on the architecture around everything else. Let's fix hybrids. Let's fix treaties. Let's fix all of the plumbing, the international tax plumbing, and see if that essentially takes care of taxing the digital economy. Well, the short answer is that despite all of the progress, and some would say success, of the BEPS initiative, there was still, there was still the perception there was a lot of untaxed profit floating around that needed to be taxed. And that led to the OECD's two-pillar initiative, with the recognition that some profit needed to be allocated to a market jurisdiction. Market countries needed to get something. And there was an emerging consensus that market countries were entitled to something, even if a company did not otherwise have nexus there. And so there was another attempt through the first iteration of Pillar 1 to try to tax the digital economy and figure out a basis by which market countries were going to be able to tax the digital economy. That was a valiant effort, but led to definitional challenge on what's digital, what's consumer-facing business. And as a result of those challenges and further delays, countries became impatient and started imposing digital services taxes. And that, of course, led to trade disputes, accusations that digital services taxes were discriminatory against the large US digital businesses. And with the change of administration in the US, the Biden administration suggested, well, let's change the focus here. Rather than focusing on digital and trying to define digital and what's digital, let's just focus on size and profitability and allow countries to tax some of the premium profits of the largest multinational companies. And so that was the big shift that led to that, as we'll discuss, that led to the latest iteration. And with the change of administration, there was also sort of renewed optimism that a deal could be reached. The Biden administration abandoned the Trump administration's insistence that Pillar 1 be a safe harbor. And so with the change of administration, renewed optimism, and that's what eventually led to the agreement that we're now going to dig into. And so with that, I'll turn it over to Jenny, who's going to talk through the details of Pillar 1.
Thanks, Mike. Let's maybe turn to slide 5. Thanks. And Mike talked about this a little bit, but I think it's important to take a step back and just think about how it is that we finally got 130 plus countries around the world to agree to this new framework, which is really a significant departure from our international, tax principles that have lasted for more than 100 years, right? Pillar 1 is walking away from our traditional permanent establishment rules and our traditional transfer pricing rules, right? This is a significant departure from the arm's length standard as we all know it and have, complied with it for decades. And so where Pillar 1 started, it was first introduced in January 2019, and it went through several reiterations, the most recently just being a blueprint that came out last fall. And it was extraordinarily complex. It led to trying to ring fence, segments of companies to kind of carve out the digital businesses within those companies and the consumer-facing businesses to create this new nexus standard based on sales that would kind of reallocate taxing rights to certain jurisdictions. But as the comments to those framework, came out, that the Pillar 1 as originally proposed was essentially unworkable, that the complexity that it was going to take in order to comply with it and in order to enforce it just simply made it untenable. And so then the Biden administration, as Mike suggested, came out with this new Pillar 1 proposal, which is really focused on simply looking at the most profitable companies. And Mike, next slide, please. Right. And so the proposal, which has now essentially been adopted by the inclusive framework, was to look at companies that, have revenue in excess of 20 billion euros, so, approximately 23 billion US dollars, and profit margins over 10%. And what this really is, in many ways, it's saying, dear companies, you're so profitable that we should be able to tax you more than any other company around the world. And you're so profitable that we're going to throw out our traditional taxing rules so that we can reallocate taxing rights to the countries where perhaps you're doing business in, but they're not under, traditional rules, they don't have any rights to tax them. And so, this is where we're headed. The in-scope companies, there are currently 2 industries that have been excluded, and James will talk about this more, extractives and regulated financial services. So it's, even within these in-scope companies, there are still countries that are negotiating to carve out sectors or industries that really affect, their own country. The allocation rights, what this does is this allows an allocation of what we'll call amount A, and we'll talk about what amount A is, to a market country when the company derives at least 1 million euros in revenue from that jurisdiction. So what this really means is if you are, without having a permanent establishment, if you are selling products into or just services into a country where you have at least 1 million in revenue from that country, then we are now going to allocate, or the countries are now going to allocate, taxing rights to that market country. And in order to accommodate the smaller developing countries, there's a nexus rule to address, developing countries where they don't have, they're smaller. So if your GDP is lower than 40 billion euros, so this is many of your African countries, right? The nexus is set at just simply 250,000 euro. So, you have 2 different nexus standards depending on where the country is. And what the amount is, and this is sometimes referred to as amount A, is that you allow between 20 and 30% of the residual profit of the company will be allocated to the market countries. Now, it currently is between 20 and 30% because as of July 1st, when the inclusive framework came out with this statement, right, they hadn't agreed on what percent of that residual profit should be allocated to the countries. And this is one of the details, many that will to be discussed, that need to be agreed upon between now and the next G20 meeting in October. So some countries are allocating that, of course, it should be 30% of the residual profit, but it'll be anywhere between 20 and 30%. And the residual profit is then defined to simply be profit in excess of 10% of revenue. So traditionally, or not, maybe not traditionally, but historically, Pillar 1 was going to look at your traditional arm's length, intercompany arrangements to come out with pricing. So you would determine your routine profits, and then you would figure out what the residual profit to be reallocated was on top of your traditional arm's length pricing. Well, now we have a defined term, right? So the residual profit is any profit in excess of 10% of revenue, despite all the intricacies and individual circumstances of each company. There's a revenue-based allocation key, which is yet to be determined as to how any of this is going to work. But it's really clear that what this is doing is it's reallocating the right to tax a certain amount of profits from each company to the market country. One of the questions that I think is still open is from what country is this being reallocated from, right? Is it the company's parent country? Is it the company, if the company has all of its IP located in another jurisdiction, is that the country where these taxing rights are being reallocated from? Can your company choose where it is going to be reallocating these profits from? And I think these are one of the many questions that needs to be worked out between now and October. Next slide, please. So one of the other significant rules that needs to be developed is how do you determine what revenue gets sourced to these market countries? And this is a really challenging question because if you take a seemingly simple scenario of just your VP, well, not simple, but if you have your consumers logging into the internet through a VPN, how do you identify where those consumers are? If you have a UK citizen visiting Spain and booking a tour of the Eiffel Tower in France, which country gets those taxing rights? And so I think it really is going to be interesting to see how these rules get developed. And this was an area where initially there were a lot of comments about, because I think one of the misperceptions from the OECD and the countries is that it's very clear. They seem to think it's simple, right? They seem to think that companies already have all of this information and data. And so the companies can simply take what they already have and just simply apply whatever these rules are going to be. But as we all know, that's not that simple. And a lot of this is going to require creating new systems or integrating systems that have never talked to each other in order to come up with the data to figure out what these revenue sourcing rules are. The tax base for Pillar 1, they're looking at financial accounting income statements. They've said there'll be a small number of adjustments, but they don't know what those will be. Similarly, going away from the Pillar 1 blueprint that we saw initially, segmentation is now going to be limited to exceptional circumstances based on your segments disclosed in the financial accounts. And certain large companies have been called out by name from these OECD, from the OECD, because while they may exceed the revenue threshold, they don't exceed the profit margin threshold on a consolidated basis. And so the countries looking to find ways to tax certain companies specifically, I think this is where we're going to see some of these segmentation rules come out. It remains to be seen whether companies will be allowed to segment, because perhaps it's easier or in the company's interest to segment based on their financial accounts, or if who is going to dictate when segmentation is allowed. There's, again, one of those details that remains to be seen. Next slide, please. So one of the other problems in order to avoid double taxation is that sometimes residual profits are already taxed in these market countries. And so there will be a safe harbor to be developed that will cap what the residual profits are allocated to these market countries in order to limit, avoid double tax, or also to avoid that too many profits are being allocated to these countries. And so again, we'll see what happens, and the devil's really in the details for all of these rules. Again, also double tax relief. So the OECD has made it very clear that they are focused on trying to minimize double tax, and will be creating systems in place to do so, along with systems in place to provide tax certainty for taxpayers, right? And so they're setting up separate dispute prevention and resolution mechanisms that will address this, mandatory and binding, provisions. But I think one of the open questions that remains is, how do you measure compliance here? Because if you have a dispute between country X and taxpayer Y about the sourcing of the revenue to each country, where is that going to be handled? And how are you going to really truly avoid double tax when every country is going to want a bigger share of the pie? And maybe flipping ahead to the next slide. So under the original Pillar 1 framework, there was an amount B, which is creating arm's length standards or simplifying, your routine marketing and distribution activities returns. It's still unclear to me, at least, how amount B fits into the new Pillar 1, but there's definitely going to be details worked around to create just a routine marketing and distribution activity returns. This may be how they come up with the capping of the residual profits that get allocated to these marketing countries. But this is one of the areas that, again, we'll see how things work. James is going to talk about the unilateral measures and removing the decision within the statement to remove all of the digital service taxes from local countries. So implementation is interesting. So the OECD is moving quickly. The next G20 meeting is in October. And before then, we should expect to see a detailed plans and a final agreement, along with an implementation plan that would create a model legislation for each country for Pillar 1, along with a forthcoming multilateral instrument to be enacted by all of these countries that Grace Perez Navarro from the OECD actually spoke this week and said that in the OECD's view, they think the compliance cost for companies to comply with Pillar 1 will be at a minimum. I'm not sure how that's going to be. And well, again, I think that's really interesting, and I think it shows perhaps the discontinuity between what companies are looking at when they look at the details and what it actually takes to determine, sourcing to each country at this level versus, the OECD's view of this. More interesting, she also said that the transfer pricing rules haven't been completely abandoned, right? So Pillar 1 sits on top of the transfer pricing rules. But this is just a foray into formulary apportionment for the small portion of amount A. And for those of us here in the States, we are used to dealing with, different ways of formulary apportionment, and we know that that has not avoided double taxation or triple or quadruple taxation at the state level. So anytime I hear formulary apportionment being tossed out as like the be-all and end-all solution, I think to our states, and I'm like, well, everybody does things differently, so it's really going to be interesting to see how this all plays out. And maybe since I know I'm over my time, I think I've talked about a lot of the open questions. We'll flip ahead to James.
Thank you, Jenny. I'm going to expand on a couple of points that Jenny touched on in her comments. The first of these is the Pillar 1 carve-outs. So recall that the Pillar 1 blueprint in October last year provided some details on industry-specific carve-outs. It broke those down into 4 broad areas. The first exclusion was natural resources, itself further broken down into non-renewable, extractives and renewable. Theory being there that the profit from extraction is kind of part of the price paid to the local country, and therefore any tax related to that should be payable to the nation where the resources are extracted. Second area of exclusion is regulated financial services. Theory in this case being that because you have regulation in local markets, you're going to get the local market pickup of the tax anyway. Note that unregulated financial services would not be excluded. Third exclusion in the blueprint was infrastructure and construction. And here I think the thinking was more that on first principles, infrastructure, for example, or commercial construction, you wouldn't expect that to be within scope of automated digital services or consumer-facing businesses, which is really what Pillar 1 is aimed at. On residential real estate, the blueprint said the exclusion would relate to construction and not sort of commission from sales, if you like. Final exclusion in the blueprint last October was airlines and shipping. And again, the theory here was that, the way that airlines and shipping have been taxed historically, particularly under their OECD model, is a bit different to other industries anyway, and therefore questions of what constitutes a permanent establishment and how much income you should allocate to a permanent establishment has always been dealt with a bit differently for airlines and shipping. So with all that as background, what did the G20 statement say? Well, it said the following: extractives and regulated financial services are excluded. That's it, nothing more than that. No detail provided, no definition of extractives, no definition of regulated financial services. So does that statement mean, for example, that natural resources, infrastructure, airline shipping, those things are no longer excluded and therefore they're within scope? I'm not so sure it does mean that. First of all, there's the argument that we just touched on, which is that if something's not caught on first principles, such as infrastructure, because it doesn't really involve consumer-facing business, for example, do you really need an exclusion for it? It doesn't necessarily mean it's within scope. And in some ways, this, of course, was the preferred approach of the US Treasury, as Jenny was mentioning earlier. For example, not having too many industry-specific carve-outs, but instead just relying on the principles of the way Pillar 1 changes should be drafted and limiting the companies that would be in scope. by reference to their size. It's also worth noting that the OECD highlights brochure, which was released in the wake of the G20 statement, so after the G20 statement was published, still does refer to exclusions in relation to shipping, for example. So it would seem that the debate about exclusions is ongoing, and we'll need to wait and see, what the next statement looks like, what the next details look like, which was due to be in October this year, although I suspect more likely it's going to be next year. Next slide, please, Mike. So Jenny also touched on the statement referring to coordination between implementation of Pillar 1 and the removal of existing unilateral digital services taxes. So to illustrate this, we thought we'd just spend a couple of minutes on the UK DST. Next slide, Mike, please. Thank you. So the UK DST is a new tax. It applies from 1st of April 2020 on gross revenues to UK users from social media, internet search engines and online marketplaces. So it's a classic digital services tax. The rate's 2%, only applies to UK revenues over 25 million and to businesses with global revenues over 500 million. So obviously targeted at top-end businesses. From when it was first consulted on by the UK government, consultation started in 2018, it was heralded as an interim measure. Now, there's no sunset clause in the UK legislation in the same way that you sometimes have sunset clauses in US tax legislation, for example. But there is, very unusually for the UK, there's a clause in the legislation which requires the UK Treasury to conduct a review of DST before the end of 2025. At the June 21 G7 meeting, the UK Chancellor reaffirmed the UK government's commitment to remove DST as soon as Pillar 1 is in place. But how likely is it that we're going to have a Pillar 1 solution anytime soon? Obviously, there's a lot of political discussion still to be had. So I think an alternative impetus for removal of the UK DST, and indeed DSTs that have been brought about in other countries, may be tariffs. I think Mike mentioned, Jenny mentioned, the US Trade Representative's Office said in January that they felt the DST is discriminatory against US digital businesses. And in June, the Trade Rep Office confirmed 25% tariffs on certain UK imports to the US as a result. The same, again, I think was applied to a number of other countries that have brought about DSTs, Italy, Spain, for example. These tariffs were suspended for 6 months pending ongoing discussions. But those tariffs will have a role to play going forwards, perhaps as important as implementation of Pillar 1. Just a final word about the UK DPT. So sorry for the acronyms. This is the Diverted Profits Tax. This targets, amongst other things, avoided permanent establishments. So it's certainly in the same ballpark as elements of Pillar 1. But it's notable that the UK government has said nothing at all about DPT being an interim measure. It said nothing at all about removing DPT, even if Pillar 1 is implemented. Now I'm going to hand over to Ken to talk about Pillar 2.
Okay, thank you, James. So Pillar 2 has sort of many names. It's called Pillar 2, it's called the Global Anti-Base Erosion Proposal, it's called GLOBE, but in the press it tends to be called the Global Minimum Tax. And it was apparently adopted by in essentially the same form that was provided for in the October 20 blueprint, with the income inclusion rule, the undertax payment rule, and the subject to tax rule, which we'll talk about in a minute. The big unknown was there's going to be a global minimum tax. What rate is it going to be? For many years, for a couple of years, people have bandied out about the 12.5%, that Irish tax rate. The Biden administration wanted 21%, but the compromise agreement that they've reached is that it should be at least 15%. So it could potentially be more than that, but who knows? Most of the Pillar 2 rules are intended to be included in a globe model legislation to be adopted by countries effective in 2023. And the STTR piece of it, and again, we'll talk about the three of them in a minute, is intended to be done by treaty. So the basics of GLOBE are that, and the primary rule is essentially a controlled foreign corporation type regime under which the parent at the top would be subject to tax on income of any foreign subsidiary or permanent establishment if the effective tax rate imposed on the subsidiary or the PE is less than 15% or whatever the minimum rate ends up being. So it's just simply an income inclusion rule like any CFC rule. However, it's always possible that the parent country might decide not to implement an income included rule, in which case, but it may have subsidiaries in countries that do have adopted the GLOBE rules. And so as a backstop, there is the so-called under-taxed payment rule, UTPR, under which the same top-up tax that would have been imposed at the parent level can be imposed at the level of one or more affiliates, including tax that could potentially relate to the parent. And there's an extremely complicated mechanism for determining how and which affiliates are going to be subject to this top-up tax, and it could be a number of them, and it more or less looks to intra-group deductions, but it's paralyzing complexity when you go through the Pillar 2 methods of doing it. You just can't even understand it until you read the examples. And once it's determined what affiliate is going to be subject to that tax, they leave it up to the country to decide how to impose it. They could just deny deductions for related party payments, or they could just otherwise increase taxable income. So there's a lot of details there. The third mechanism is really there primarily for developing countries. And if there are interest, royalties, rents, and a few other types of related party payments made to a payee that is resident in a country that has less than the minimum tax, then the payer, by virtue of a change in tax treaties, the payer country can require that there be a withholding or other tax imposed on the related party payment, such that, in essence, between the difference between whatever the minimum rate is and what the rate otherwise would have been in the treaty. Other rules. The threshold would be the same, 750 million. It's in the country by country reporting. The top up ETR test would be done on a jurisdiction by jurisdiction basis. So you had one subsidiary with a 25% rate and another with a 10% rate. You couldn't average the two. Because the U.S. GILTI rules currently allow averaging of foreign taxes across different jurisdictions and allow losses to be used under the GILTI rules from one to the other. Although the Biden administration will change this. The statement says, and it's not clear what this means, it says consideration will be given to the conditions under which GILTI will coexist with the GLOBE rules to ensure a level playing field. Now, the government, both the Trump and the Trump administration have been advocating for a so-called GILTI grandfather. It's not clear to me whether this means that GILTI would be fine or whether they would ask for some changes. Okay, carve-outs. As a formulaic substance carve-out, under which 7.5% or 5% and later after 5 years of the carrying value of tangible assets and payroll would be excluded from the Pillar 1 inclusion amount. This is similar to the GILTI exclusion for 10% of qualified business assets, or QBI, which the Biden administration, of course, is proposing to get rid of. It also would not apply to parent entities that are government entities, international organizations, pension funds, or investment funds. And those, if you look at the Pillar 2 Blue Book, they have definitions, for example, for investment funds and for all of them. Okay, there'd be only one industry carve-out, and I'm happy to say, since I've been working on this for 2 years, almost, as for the shipping industry. As James had said, there had been a Pillar 1 one, and we're hoping to get that back in, but only one industry carve-out here. And the phrase devil in the details has been mentioned more than once, and I think it's fair to say that it's too bad that there isn't more transparency to what they're working on, because I have seen some of what they're working on in terms of shipping, and some of the things that they're thinking about are not as broad as you might think it would be. And so, the various things that Jenny, you were talking about in terms of the devil of the details of the key and so forth and so on, and how you allocate it to sourcing, it would be good if there were rules in place, or proposed rules in place that people could comment on. I'm a little concerned that come October, there's going to be a new plan, and it's going to be very hard to get any changes made at that time, but we shall see.
Yeah, and switching gears to the Green Book, although there's so much overlap now between what the OECD has proposed and what's in the Green Book proposals. Perhaps for the first time ever, there's actually overlap between the two. But just some quick highlights. The Green Book, what came out at the end of May, it's kind of the proposals or the aspirations of the administration for their FY 2022 spending plans. Not surprisingly, there are significant corporate tax increases, either through the direct change to the tax rate up to 28%, or to the various provisions, many of which we're going to talk about, that would increase net revenues for the U.S. One thing I'm just going to throw out in the Green Book real quick is that the Green Book is aspirational. So while many of these provisions may not see the light of the day, they tend to be sticky and they may stick around. And one easy example of that is if you think to the definition of intangible, that was first proposed in Obama's 2007 Green Book to expand the definition of intangible to capture goodwill and going concern value. But those changes didn't actually make it their way into legislation until 2017. So they, hung out there for 10 years before the changes actually came into play. And so with that, I will switch over to let Lucas talk about GILTI changes.
Actually, it's me.
Sorry, Ken.
Go ahead, Ken.
If you want to do it, that's fine.
No, go.
Yeah, go ahead, Ken.
Okay,
Yeah.
so the Biden administration has proposed pretty major changes to the GILTI rules, which, as I'm sure everyone knows, is the controlled foreign corporation provision, under which substantial amounts of income of CFCs are currently included in the income of the U.S. shareholder. And they're really proposing apparently 4 major changes that would make the GILTI regime much tougher. I'm going to be very interested to hear what Warren Payne has to say at the end of this as to what he views as the likelihood of these things getting through. So the first one is, currently, if you have a GILTI inclusion, you get a deduction for half of it, with the effective tax rate on that income being 10.5%. They're proposing that deduction be reduced from 50% to 25%, and that with the proposed increase in the corporate income tax rate to 28%, that the rate on GILTI would be 21%, so effectively doubling the rate. You know, I suppose 21% is better than 28, but that is a huge, huge increase. The second change, which may be as significant for some companies or more significant for many companies, is that, you know, currently you're able to average your foreign tax rate from high tax and low tax jurisdictions for foreign tax credit purposes. This would change that. You'd have to do it on a jurisdiction by jurisdiction basis, such that if you had an inclusion from a 10% rated country, you can't average that with your rate from Germany or wherever. And given the fact that the GILTI regime does not allow carrybacks or carry forwards of taxes imposed on GILTI, and given that there's already a 20% haircut, so you only get 80% of the foreign taxes, this, for many companies, this could be just a huge, huge change. Okay, the third one, which is not, I say apparently there because it's not actually referred to in the Blue Book, but currently, if you have a loss in one jurisdiction, you can offset a GILTI loss in one jurisdiction, you can offset it against GILTI income in another jurisdiction. It would appear, although it's not clear, that would end too, just like the averaging of the foreign taxes from one jurisdiction to the other would change. And lastly, this is kind of an ironic one. You know, currently there's an exclusion from GILTI for 10% return on the CSE's QBI. It's depreciable tangible property used in the business. That would be repealed. And the rationale that the exclusion encourages investments outside the United States, which I suppose it does, although I haven't seen many companies doing that. And it's also kind of ironic since GILTI was aimed at trying to tax intangible income and not to tax tangible income. And that whole underlying premise under the Biden administration would go away. A couple of other changes: the high tax exceptions for CFC subpart F income and GILTI would be repealed. And there also would be some changes to how deductions are allowed and disallowed when you've got participation exemption income and so forth and so on. To be honest with you, it is really hard to understand what the impact of these changes would be, and there needs to be more detail. And there probably will need to be modeling by companies once it becomes clear what it all means. I can't tell whether this is a big change or a little change at this point. So those are the pretty big changes to GILTI.
So I'm just going to walk through some of the most relevant aspects of the SHIELD, which is yet another acronym, stands for Stopping Harmful Inversions and Ending Low Tax Developments. And it is the Biden administration's proposal to replace the BEAT, which I'm sure most of you here are familiar with. So in the Green Book, there's an explanation as to how the BEAT ultimately does not properly address the concern of the erosion of the U.S. tax base. There's several objections raised that because it is a minimum tax, it may or may not affect the company depending on its profitability, and that this allows deductions for payments made to related parties regardless of whether the related party is subject to a high or low tax rate. So in lieu of the BEAT, the Green Book proposal introduces the SHIELD, which is a rule that would disallow deductions to a U.S. corporation or a U.S. branch of a foreign company on payments that are made or deemed made, and I'll come back to the deemed made aspect of this in a second, to a low tax member of the same financial reporting group. I would say the shield is clearly inspired by the under tax payment rule that Ken was referring to in Pillar 2, but it does have significant differences. In terms of the scope and the taxpayers that would be subject to the shield, the Green Book states that it would apply to financial reporting groups with global annual revenues in excess of $500 million. So first, one difference to note with Pillar 2, which as Ken was referring to before, sets the threshold for the scope at 750 million euros. So in theory, it could be possible that you could have companies that are subject to the shield and are not subject to the Pillar 2 rules. Now, if we compare this with the scope of the BEAT, and I think this is interesting. In the BEAT, as you may know, there's also a 500 million gross receipts threshold in that case. But for that purpose, we only take into consideration gross receipts that are essentially subject to US tax, either from US corporations or from foreign corporations of the group that are subject to US tax. Here in the scope of the shield as laid out in the Green Book, we're looking at the global revenues of the financial reporting group. So it's much broader in that respect than the BEAT. And there's also no minimum base erosion percentage threshold as the BEAT has for those who are familiar with the BEAT. So that's not a consideration. If the financial reporting group has global revenues in excess of 500 million, it would be subject to the shield. What's the minimum rate that sets the threshold for what is a low tax member for purposes of the shield? The Green Book says that is going to be the minimum rate agreed to under the Pillar 2. And if the shield comes into effect prior to the Pillar 2 agreement, that is going to be the 21% rate, which is also what the GILTI proposed rate is under the Green Book. And this is always talking about effective rates. I think there was a question before in the chat box relating to exemptions or incentives that certain jurisdictions may give, at least for purposes of the shield, as laid out in the Green Book. We would be referring to effective rates and not statutory rates. So next slide, please. So the shield will clearly apply when we have a payment made by a U.S. corporation to a low tax member of the group. At that point, the shield would disallow the deduction if it's deductible payment in its entirety, different from the Pillar 2 under tax payment rules proposal, where there's only a partial disallowance, maybe under the top-up rule. Under the shield, the disallowance would be complete. The language in the Green Book is very broad in that it refers to any gross payments. So potentially some of the BEAT exceptions that we're familiar with, such as exceptions for services, payments for services to an affiliate that qualify under services cost method, qualified derivative payments, etc. Query whether those exceptions would now be incorporated into the shield. Possibly some of those would be lost given how broad the language is in the Green Book. And then the second bullet here, I think, highlights one of the key aspects of the shield, in that so long as there is one low tax member in the group, any payment made by the US corporation to a foreign affiliate, even if the payment is going to a high tax member, is going to be deemed to be made in part to the low tax member or members of the group. So each payment is going to have a portion, it's going to be pregnant with a portion of a tainted payment, deemed payment made to a low tax member. And that allocation, the Green Book tells us, is going to be based on the ratio of the group's low tax profits over the group's total profit. So an amount of that payment, even if made to a high tax affiliate, is going to be treated as having made to a low tax affiliate. So there's, I'm sure, going to be a lot of complexity when that rule is fleshed out, but that's, I think, one of the key aspects of the shield, that it doesn't really matter whether the payment actually goes to a low tax member. You can still have this allowance for payments made to high tax members. And the only one other point I would highlight is, under the BEAT, as we know, cost of goods sold, payment for cost of goods sold, inventory purchase from a foreign affiliate, is not subject to the BEAT because technically it's not a deduction, it's a reduction in gross receipts, it's above the line for US tax purposes. Well, that is no longer the case with the shield. Cost of goods sold payments purchases of inventory from foreign affiliates could result effectively in disallowance of deductions under the shield. And the way the Green Book explains the mechanics would work is the cost of goods sold payments itself is not going to be disallowed, but there's going to be an amount of deductions disallowed for an amount equal to the cost of goods sold that is tainted under the shield rule. So effectively, for some reason, unclear whether there's a concern that if they would just disallow the cost of goods sold, there would be constitutionality challenges or some concerns about compliance with international obligations, but they have this mechanics where they effectively disallow other deductions. And just last point, as we mentioned there, the proposed effective date for the shield is deferred until January 1st, 2023 in the Green Book, possibly to give some time for Pillar 2 agreement to be reached on the minimum tax rate. So I'll turn it back to Jenny now for a discussion on the inversion changes.
Yeah, so just a few points on the anti-inversion rules, because I want to make sure we leave enough time for Warren. You know, this continues the new proposals are significantly broaden, 78, 74 to just essentially disallow or disincentivize any type of inversion. And the rules proposed are so significant that they may actually pull into what I'm going to call innocent transactions, where you may not be intending to have an inversion, but you may inadvertently run afoul of the rules. They lower the ownership continuity percentage to greater than 50%. And next slide, please, Mike. More importantly, I think it's important to keep that the proposals actually set up a new rule that would expand the inversion rules to comply regardless of the continuing ownership percentage. And I want to focus on the primarily managed and controlled in the United States after the acquisition. So this would say, even if you, meet the continuing ownership percentage, if after the acquisition, the affiliated group is primarily managed and controlled in the U.S., we're still subjecting you to these inversion rules. I think this is really significant for many of the companies that have historically inverted, just knowing what's happened afterwards. Few things, I think one more thing of note, the Biden's proposed effective date is simply for transactions that are effective after, or transactions that go on after the effective date or the enactment date of the proposal. There's 3 other anti-inversion bills pending. One of those has with similar rules, and one of those has an effective date that would go back to May 2014. So I think with all of these rules, it really comes down to just keeping an eye on what is that effective date, and is it retroactive or prospective for these transactions? Mike?
Great. So I just want to take 1 minute and talk about some of the proposed interest expense limitation changes, and then a second on some of the other miscellaneous items in the Green Book, and then we'll turn it over to Warren. So the Green Book proposes yet another limitation on the deductibility of interest. We're all familiar with the plethora of interest expense limitation deductions. We're now going to have a new one, which essentially is going to compare the U.S. The amount of interest you're deducting in the U.S. with the amount of interest you're deducting on a consolidated basis. And if your U.S. interest expense on a pro rata basis is higher than your consolidated interest expense, then there's going to be a haircut on your interest expense limitation to bring it in line with what your consolidated interest expense limitation would be. So the short summary of this is that this is designed to prevent over leveraging in the U.S. relative to your interest expense around the world, and they're going to use relative EBITDA as the test for determining whether you're over leveraged in the U.S. So there's this is going to apply side by side. This is proposed to apply side by side with current 163J. So whichever limitation gets you whichever limitation gets you the lower deduction, that's the limitation that's going to apply. Complex carry forwards, et cetera. We're not going to go through those. Let me just take 30 seconds to talk, just to highlight one other proposed Green Book change, and we'll turn it to Warren, and that's the repeal of FDII. I mean, this is, if you think about companies after TCJA that responded to the call of the TCJA to bring their IP back to the United States in return for a 21% rate and access to the FDII incentive, this is the ultimate legislative bait and switch. And what it really reminds me of, if those of you remember the movie Animal House, there's a phrase in there that said, face it, you screwed up, you trusted us. And there were a lot of multinationals that brought IP back to the United States in reliance on FDII. And that is now, proposed to go away. So with that, let's turn it to Warren and talk about what all this means, where it's going, and what the future holds for us.
Thanks, Mike. I'm going to do a 3-minute idiot's guide to how tax policy might be enacted via the U.S. Congress. And if you thought the international negotiations were complex and had a lot of moving pieces, you ain't seen nothing yet. Set some basic table setting here. We believe that both Pillar 1 and Pillar 2 require both statutory and treaty changes in the United States. I will caveat that there are some pundits out there who speculate that the U.S. may be able to implement without treaty changes. That's not our view. We also think that if Congress and the administration were to try to do implementation of Pillar 1 and Pillar 2 without treaty changes, it would pose some risks as a result of those treaties that are in force still being out there and being inconsistent with the new statutes. Obviously, treaty changes are a Senate exercise only, and it requires a 2/3 vote in the U.S. Senate. Getting a 2/3 vote in the U.S. Senate is extremely hard in a good situation, and right now the Senate's a 50-50 split. So very unlikely, in our opinion, that treaty changes have a high probability of getting enacted. Now, there is a legislative process called the budget reconciliation process that could be used to make the statutory changes. The budget reconciliation process is an expedited procedure, allows Congress to enact legislation with a fiscal impact, a fiscal policy only, and avoid the filibuster in the Senate. So they can do it with 51 votes. TCJA was enacted this way. The Affordable Care Act was enacted this way. The tax cuts in 2001 and 2002 in the Bush administration were enacted this way. There is significant precedent. That process is literally kicked off this week in the Congress, and we'll come back to that in a minute. But a couple things to keep in mind as Congress looks at the OECD negotiations and outcomes as it contemplates what to do domestically. First, strong bipartisan concern about the lack of clarity on repeal of DSTs. This gets to the lack of clarity overall. This gets to the lack of clarity on the EU position with their supplemental EU-wide DST that they have stated is consistent with the OECD negotiations. And as James mentioned, U.S. Treasury and Congress, at least some stakeholders in Congress, are not limiting their concerns to just straight DSTs, but things like the DPT and other value-added tax changes we've seen in other Asian countries. Kind of a more macro level, certainly strong concern from congressional Republicans who shepherd TCJA through Congress and into law about a number of the changes, particularly the higher corporate rate and all the changes to GILTI that you just heard about because they are so inconsistent with TCJA, but also kind of bipartisan concerns about how the overall package impacts the competitiveness of the United States and the U.S. tax base. There is a lot of concern about the possibility that implementation of the OECD proposals could result in a significant erosion of the U.S. tax base under Pillar 1 as taxing rights are shifted from the U.S. Treasury to other jurisdictions. We can advance to the next slide, please. So, as I said, Democrats are starting to work on the partisan reconciliation package beginning this week. The Senate has put forth an outline that totals $3.5 trillion That 3.5 trillion is a combination of revenue increases and spending increases. The question is, how much of that 3.5 trillion in tax cuts, such as extensions of child tax credit, Affordable Care Act subsidies, and other spending programs is paid for? I would note that the Green Book proposals, as you heard about earlier this morning, total 2.5 or 2.4 trillion. So even if they could enact everything in the Green Book, they're still $1 trillion short. And they can't enact everything in the Green Book. We know they can't get to 28% on the corporate rate. And highly likely that stepped up basis cannot be enacted in the law. If you can't enact stepped up basis in a law, you can't take cap gains to ordinary rates. Then there's going to be a need for political reasons to provide SALT relief in this package. And you've heard a couple people talk about one significant tension between the Pillar 2 proposals and the Biden administration proposals. And that's the kind of blatant inconsistency between the 7.5 or 5% exclusion based on tangible assets and employment that's in the OECD proposal versus the Biden administration's proposal to repeal QBI in its entirety. So all of those things create a great deal of friction and difficulty in convincing members of Congress to vote for a reconciliation package that makes all of these changes in it. There is, however, going to be very significant counter pressure, and that's because of all the other goals that the reconciliation bill is intended to achieve. Things on infrastructure spending, things on education spending, things on healthcare spending. All of these things will put significant counter pressure on members because they are going to need to find revenue to support this other spending. And so there is going to be a tension between their concerns about some of these tax policies and their need to find revenue. I'll finish up with one point on timing. Reconciliation is a two-step process. Step one is adoption of a budget resolution. The goal for Congress is to wrap that up before it leaves for the August recess. It would then come back after Labor Day and put together the actual implementing legislation that would include all of these changes. So buckle up. We're going to have a crazy few weeks to see if Congress can actually get part one in the budget resolution done. If it can, then we're on to part two, which is the actual implementing legislation, which will be even more controversial and crazy. Mike, I'll throw it back to you.
Great. Just to all that remains to say thank you everyone for joining us for this. You'll receive the slides and the reporting in an email. And again the CLE code is 07 Reform 15. And thank you for joining us, and we look forward to seeing you at our next webinar. Take care. Thank you.